how to manage risk for swing traders. So most beginner traders think risk means how much money they put into a trade. So for example, if they buy $5,000 worth of PTRN, they think they're risking $5,000. But that's not how trading works. You could buy $5,000 worth of this stock and only risk $100, or you could buy $500 of it and risk all the $500 of it and only sell it when it goes to completely zero. But any good trader is going to know that that's not what you do. So in this video, I'm going to break down what risk actually means, how to calculate it before you enter a trade, and why this one concept is the difference between traders who survive and traders who blow up their accounts. So let's start simple. Risk is not the amount of money you invest. Risk is the difference between entry price and your stop loss. That's it. Let's say you buy $50 of a stock and you decide if it drops to 48, you're wrong and you exit the trade. Your thesis is no longer valid. So you're risking $2 per share, not $50, not the entire investment of $50 on that stock. You're risking only $2, not the account size, just the difference between your entry price and your stop price. That is the most important concept in trading, and that most beginners completely misunderstand. Because until you understand this, you can't properly size your positions or control your losses. So, for example, let's say on Friday you would have bought the PTRN at $22 and you want to risk your stop loss is at $21. That's $1 per share. And say you want to risk $100. So your entry is 22, your stop loss is 21. That's $1 per share. $1 multiplied by 100 gives you $100 of risk. So you buy 100 shares. That simple. And that's why stop losses are so important. A stop loss is not there because you expect to lose. It's there because no strategy works 100% of the time. Even the best setups fail. So the stop loss defines your risk before you enter the trade. Professional traders, they don't avoid losses, they control them. That's the difference between amateurs and professionals. Amateurs try to avoid losing. Professionals make sure their losing trades are small. So position size, this is where everything really starts to come together. So let's say your account is $10,000. Say you have $10,000 in your brokerage account and you decide you want to risk 1% of that. So that's $100 on a trade. Now let's say your setup gives you a $2 risk per share. That means 100 divided by 2 equals 50 shares. So you can buy 50 shares of that stock, and that's only $2,500. But here's the key. You're not risking $2,500. You're risking $100. Big difference. Because if the stock hits your stop loss, you exit the trade and lose only your predefined risk. That's how professionals stay in the game long term. They control position size based on risk, not emotions. Now, risk versus reward. Let's say you risk $100 on a trade and your target reward is $300. So you want to make $300. All right, that's a risk of 3 to 1 ratio, so a 3R to a 1R. Now, 1R is your risk, 3R is your reward. And that's where most beginners get stuck. You don't need to be right all the time to make money. So to break that example down further, let's say you win 4 trades, each out of 3R. So that's $300 times 4 winning trades. That's $1,200. Now, you lose 6 trades. So out of 10 trades, you won 4 and you lost 6. But each of those 6 trades is a 1R loss. So $100 times 6 equals negative $600. So you add both those numbers together, you made 1,200, you lost 600, your net result, 600 plus. So you made $600. Even though you lost more trades than you won, you're still profitable. And that's the power of risk management. It removes emotions and focuses on probabilities. You don't have to be right 100% of the time. You just have to get your risk management correct and your risk to reward correct. Now, most common mistakes that beginners make, and this is the first one's a really big one. They buy a stock first and then figure out risk later. Completely backwards. Never press that buy button without knowing what you're risking. You have to have your stop loss in mind and you have to have your risk defined. So that way you don't accidentally risk $200 or $300 with a reward of only $100. It completely messes up your statistics. Second, moving your stop loss further away when the trade goes against you. This is a big psychology problem. So it's hard to lose money. And you don't lose money until you press the sell button, right? Well, yes, but no. That's how beginner traders take a $100 loss and turn it into a $1,000 loss. If you keep moving that stop loss down, you essentially are waiving your risk, and next thing you know, you have a negative 3R. And, and then you have to, and it messes up the whole statistics. So don't, once you put your stop loss, it stays there. You can only move your stop loss up. You can't move it down. Third, risk different amounts on every trade based on emotions. This completely destroys your consistency. Say, I think this one's going to be better, so I'm going to risk $100. This one's going to be better. I'm going to risk $200 on this one. The problem with that is you never know which stock is going to go skyrocketing and which one's not. There's a good chance that the one that you risk $40 on or $50 on versus the 100 is the one that's going to skyrocket. So you risked 50 on the not so great one, that one takes off, and the one that you risked 100 on, you end up losing on. It completely messes with your statistics. This is not to be said that you shouldn't change up what you risk based on market conditions. That's true, you should do that. If the market's strong, you should risk more. If the market's weak, you should risk less. Professional traders do that. But in the same day or the same week, they don't change up how much they risk. They risk $100 across the board, or they risk $200 across the board on that day versus switching it up based on the market conditions. So, fourth thing, ignoring risk to reward completely and just hoping the trade works. That's not trading, that's gambling. That's a horrible plan. So, conclusion, before you enter any trade, you should always know three things: when you enter, when you're getting out if you're wrong, and where you're going to take profit. If you don't know all three before you click buy, you're not trading with the system, you're just guessing. Alright, in the next video, I'm going to show you exactly how I enter trades step by step, including how I find confirmation and where I place those stops based on structure. If you're following along with the series, this is the foundation that everything is built on. So, and if you're liking these videos, please hit that like and subscribe button. Thanks, everybody.